Okay, hi everyone. This is going to be the video for the problems here. Let me get that out of the road. So we're looking at chapter 2. Right? A lot of this is just kind of rehash stuff. We're looking at the debits, the credits, the journal entries, some basic financial statement preparation. So we have some examples here. Some we're going to kind of go through a little bit more in depth. Some I'm going to kind of just talk about high level, right? That problem at the end. We're not going to have time in a sort of a truncated video here to do that. That could be like a whole hour, 2 hour session. So I'll give you kind of the nuts and bolts with it. But let's get started here, see what's going on, right? So we're going to work on exercise 2.1 first, transaction analysis. They say, hey, for each transaction, can you show the effects, right? So that plus minus kind of, or plus plus, we want to make sure, if you remember from the video, that we get that to balance, right? The assets equal the liabilities plus stockholders' equity. And then they want us to do the journal entries, right? And that's really what we're going to focus on here. Because this is an intermediate class, you should be at the point now where you can read this and do the journal entries, right? So let's take this one by one here. We're going to look at number 1. It says, we issued 30,000 shares of no par common stock in exchange for $300 in cash, right? So anytime you get a journal entry, you kind of need to pluck out. It's like you're filtering it. You're looking, what are the accounts? What are the effects on that equation, right? And remember, I said always start with cash. That's the easiest, right? So what did you get? And another way to think about this is, what did you get and what did you give? Here, right, we got cash, debit cash for 300,000. Likewise, what did we give? Common stock, right? Credit common stock, 300,000. Our total debits equal our total credits, right? That's great. You can put a check mark on that one. All right, number 2, we bought equipment at a cost of $40,000. Cash of 10 grand was paid and a note payable to the seller was signed for the balance, right? So what did we give? What did we get? Right, in this case, we got equipment, right? Debit equipment, $40,000, right? Well, how did we pay for this? Well, we signed a note, right? Credit note payable for $30,000. And then the rest, right, we paid cash, right? $10,000. Okay? And if you looked at it, right, they said we paid 10, they tell you 40. You could back into the note payable there. Okay, 3, we bought inventory. Let me put a check mark here too. Right, for 3, we bought inventory on account at a cost of $90,000. We used the perpetual inventory system, right? So we got inventory, debit inventory, 90,000. Right, we looks like we bought it on account, so that means credit account payable. Right, when they say the word on account, right, that's what they're talking about there. Okay. 4 here. Let's check this guy out. So credit sales for the month totaled $120. The cost of goods sold was 70. Okay. So we kind of have 2 things going on here in this case, right? Let's tackle the credit sales first, right? So we sold stuff on account, right? It was credit sales, so that means it's on and through an account receivable, right? Debit account receivable here, 120,000. And these were sales, right? So remember, we credit our revenues, 120,000. Likewise, they tell us our cost of goods sold, right? Whenever we sold that inventory, right, was $70,000, right? So it's going to be debit, cost of goods sold, and expense, $70,000. Credit, in this case, inventory for $70,000. All right. Let me kind of bold these and center it just to kind of keep us on track there. All right, 5. right? Let me put my check mark there. I've got to keep this. This is one thing when you're in practice, right? Like people are very particular about their work papers. You will have your own kind of style, and right, like you'll see like people highlight their tabs like real beautifully. As accountants, we do this kind of stuff. So like whenever I'm like, let's get that check mark there, it's because I'm used to in practice. We got to tick that off, or make sure this balances. It's within reason, right? Like you don't want to be like super over the top with it, but as accountants, right, we like kind of neatness and cleanness. So let's kind of keep going here. 5. We paid $5,000 in rent on a warehouse for a warehouse building for the month of March, right? So nothing too bad here, right? We just had some rent expense for March, right? So debit rent expense, $5,000. We paid cash, right? Credit cash, 5,000 bucks. Okay, not too bad there. Let's check out 6. Right, 6 says we paid $6,000 to an insurance company for fire and liability insurance for a 1-year period beginning April 1st. Right, so what are we doing here in 6? We prepaid our insurance, right? That's a prepaid expense, sometimes called a prepaid asset. So we're going to do debit, prepaid insurance, $6,000, credit cash, $6,000. That's great, right? We can put the check mark on 6. All right, 7, we paid $70,000 on account for the inventory purchased in 3, right? So it looks like we bought the inventory on account here. We teed up that payable. Now here in 7, we're making that payable go down, right? So we basically are, it's like you charged on your credit card, then you paid it off, right? So we teed it up with a credit. Now we're going to take that payable down with a debit, right? So that's going to be $70,000. And then we're going to credit cash $70,000. Okay. Let me kind of move that over there. Okay, I'm just kind of cleaning these work papers up. Something like this would be what you would do as a senior accountant, right? What I mean by that is like a staff accountant, you would be preparing maybe the journal entries. A senior accountant, like you would be reviewing what the staff did. Like those little kind of cosmetic things are a very common item there. And with your firm, you kind of learn the work papers specific with your firm, like how they want things presented. You are not going to walk into your first job and be like, oh, okay, I'm the genius accountant. No, there's a learning curve there. You'll be fine, but it's just kind of in the beginning, right? Be prepared. You got to figure out what specifically and how your firm does these things. All right, 8 here. We collected $55,000 on account. Okay, so what that means is somebody owed us money and then they paid it to us, right? So debit cash, 50,000, and then credit account receivable, 50,000. All right, put the little check mark there, the little tick mark. That's great. And then for 9, we recorded depreciation expense of $1,000 for the month, right? So in this case, for 9, we're going to do debit depreciation expense of, they tell us here, $1,000, and then credit accumulated depreciation, $1,000. Okay. Now I use these little shorthands sometimes, like AD, accumulated depreciation, AR, receivable, AP. Right. Audibly, if you're listening, you'll know what I'm saying there. So here's the answers, right? If you just kind of need a second to look at it, you can. I'm going to zoom out a little bit. Right. You can kind of look at that, go through there. That's great. Exercise 2-1. Let's wrap that thing up. Let's move to 2-6 here. Okay, they're telling us indicate whether a debit, right? So debit's on the left, credit's on the right, will increase or decrease each of the following accounts listed through 1 through 15. Okay, so remember we said assets equal liabilities plus stockholders' equity. And we said you have your T account, you have your debit on your left, credit on your right, your T account, your debit on your left, credit on your right. We said it's plus, minus for assets, minus, plus for liabilities and stockholders' equity. So really they're giving us an account here, and they're saying, for example, inventory, which is an asset, something you own, what does a debit do for that? Right, well, that's going to increase your inventory, right, for it. Likewise, depreciation expense, right? Well, what's going on whenever you debit a depreciation expense, right? Expenses you normally debit, revenues you normally credit. Accounts payable, right? That's a liability, right? So when you have a debit on a liability, that's going to be a decrease, right? Prepaid rent, that's an asset. A debit's going to increase it. For sales revenue, right? You normally credit revenues, so a debit to a revenue is going to be the reverse, right? That's going to decrease it. Likewise, common stock and salaries payable, namely liability and stockholder equity, that's going to decrease it. Right, essentially, if you want a framework for how I'm doing this, right, I'm going inventory, that's an asset, and I kind of work over here. The revenues and expenses, you have to think about the fact that how it ultimately tees up into it, into stockholders' equity, right? We talked about this a little in the lecture. If you have a revenue that increases your net income, that increases your retained earnings, which increases your stockholders' equity, that's why you credit revenues and credits increase revenues. Well, if credits increase revenues, then if you're talking about a debit, it's going to do the reverse. Okay, and that's why when you debit a revenue, it decreases the revenue. The reverse is true for expenses. Okay, cost of goods sold here, right? Well, in this case, that's an expense. So when you debit it, that's going to increase it. Same with utilities expense, right? Equipment, that's an asset. If you debit it, it increases. Receivable, right? Receivable account receivable is an asset. Account payable is a liability, right? So receivable is you're going to receive in the future, somebody pays to you money. Payable is in the future, you have to pay somebody. So receivable, asset, payable, liability, right? So here it's an asset, it's going to increase with the debit, right? Payable, liability, it's going to be the reverse. Expense right here, that's going to be increase, right? Because we debit our expenses normally. And then revenues, right, will decrease it, okay? So you can check that out there. Nothing too difficult, just kind of looking a little bit at those T accounts, okay? All right, so next thing they're telling us here, we got to do our adjusting entries, right? So what's going on, like if you want to think about it, right? Here was the period, right? We've been making those journal entries, as they occur, right? In exercise kind of 2.1. These aren't the same exact, setup here, but here we are at the end of the period, right? And some of the stuff that we bought during the period, we need to bring the account balances up to date, right? In other words, we need to, and to the extent we incurred an expense, accrue that expense. Likewise, so maybe we bought insurance, right here where this little X is, and then, we used 2 months of it. We need to accrue the expense for that usage. On the flip side, right, any revenue we have that we accrued, we need to account for as well. Bring that account up to balance, right? Maybe somebody prepaid to us. We're a landlord. Somebody prepaid their rent to us. No, now we've earned 2 months of it. So we got to accrue that. And in this framework, right, when we're talking about our AJEs, right, our adjusting journal entries, getting these accounts to balance, right, you have really your deferrals and your accruals, right? And what this is saying is, with regard to the AJE, your deferral is when you defer, you kick the can on it. So, hey, you maybe get or pay the money first, and then you take the expense later, right? So we bought prepaid insurance. Here we are at the end of the period, we take the expense for it, right? So it would be like this guy right here was the cash. And then here we are at the end of the period, right? We got to make our AJE for that expense. And you could have a flip side here for revenue, right? Where somebody pays you up front and then you earn it. But the idea with it is you have money first, recognition second, whether that's an expense or a revenue. On the flip side, the accrual is what's going on here is you have the expense or revenue first, then the cash comes in, right? So you're going to have recognition first, right? Maybe right here, and then later on, next period, they're going to pay you the cash on it, right? So what might be something on this? Hey, what we need to do is during the period, right, we incurred some utility expense, right? So we've used 3 months of utilities. We're going to take the expense now, and then next period, we pay the cash, right? So the idea with it is whenever we have the recognition, right, that's going to be the AJEs we do at the end of the period, right? You have your deferrals and your accruals. So it's kind of a 5-minute summary there. Let's take a look at these. Right, let's start with number 1. So we got a 3-year fire insurance policy. So it's 3 years. We purchased it on July 1st for 12 grand, right? That would be like this guy right here. They debited prepaid insurance for the entire amount of the time of payment. Okay, so we're at December 31st. All right, so we're at the end of the year, and it looks like halfway through the year we bought it, right? So let's kind of think about this. First off, for one, we need to know the journal entry. Okay, so we're going to do debit insurance expense and credit prepaid insurance. But the question becomes for how much, right? Well, if you think about it, right, we bought it for $12,000, right? And we used 6 out of the 36 months. It's a 3-year policy, right? So there's 12 months in a year. 12 plus 12 plus 12 is 36. We bought it halfway through the year, so we used 6 months, right? So 12 we paid, we used 6 of the 36. Hey, $2,000 is going to be the amount. All right, that's great. We got 1 done there. Let's look at 2. Depreciation on equipment totaled $15,000 for the year, right? So why is this an AJE? Hey, maybe we bought the asset here and now we're accruing the expense for the usage of that asset, right? So we'll debit depreciation expense, credit accumulated depreciation. Let's see here. They said it's 15,000. Put the check mark there. All right, employee salaries of $18,000 for the month of December will be paid in early January of 25. Okay, so we have some salary expense we got to accrue. So debit salary expense, credit salary payable, and 18,000. All right, on November 1st, the company borrowed $200,000 from the bank. Looks like there's interest of 12% to be paid on April 30th of 2025 next year. Okay, so what's going on here? Hey, in November, right, we borrowed money. That's great. Now we have to accrue the interest expense associated with that borrowing, right? So we're going to do debit interest expense. We're going to do credit interest payable, right? So the expense itself, we got to do a little bit of math here, right? So it's going to be the $200,000 that we borrowed times the 12% times 2 over 12. Right, so let's think about this. This is the principal, what we borrowed. That's the rate, right? That's based on a yearly rate. Accordingly, because that's over 12 months, right? Not the 0.12 that it's exactly 12, but it's 12% per year. We have to keep it apples to apples. So that's why it's over 12 here. And why is it 2 over 12? Well, we bought it in November, right? So you think about it, that's November and December, we have to accrue for, right? It's like 2 months have passed. We got to accrue interest expense for 2 months. We're looking at $4,000 there. All right, 5. On December 1st, 2024, the company received $3,000 in cash from another company that's renting office space in its building. The payment representing December, January, and February was credited to deferred rent revenue at the time the cash was received. Okay, so what's going on here? We get somebody who comes in the beginning of December, like, look, I want to prepay my rent for the next 3 months. Here is $3,000, right? For month 1, month 2, and month 3, $1,000 a month. Now we're at the end of December. 1 month has passed, so we need to accrue that revenue, right? So what we do here is we're going to debit deferred rent revenue, sometimes called unearned revenue, and we're going to credit rent revenue, right? So when they came in and they paid it to us, we teed up that unearned account, we credited it. Now over here we reverse it out as we earn it, right? So that's going to be, if we think about it, right, what's going on here? Well, they paid us $3,000, right? That was for 3 months, and 1 out of the 3 months have passed, right? Because they came in the beginning of December. We're now at the end of December, so 1 month has passed of the 3 months, right? So we're looking at $1,000, $1,000. Okay, so just some simple examples there of AJEs, not a huge deal. Let's move on to exercise 1212. Okay, so they're saying the December 31st, 2024 adjusted trial balance for Blue Boy Cheese Corporation is as follows, right? So what's going on is, right, if you think about kind of how we're unpacking this, you do the general journal, the general ledger with the T accounts. You then do an unadjusted trial balance. You do your AJEs, and then you get your adjusted trial balance. We've kind of done the functional equivalent of this, right? The journal entries in that exercise 2.1. We just did the AJEs, right? Now you can see, right, how in this accounting cycle we're kind of unpacking it here. What they want us to do, right, is prepare an income statement for the year ended and a balance sheet, a classified balance sheet, right? So that means we're going to have to just be very specific on it. And then they also want to get the closing entries. Okay, so let's kind of look at this, right? So if we look at it, we have our assets here, our liabilities, our stockholders' equities, some revenues, some expenses. That's great. Okay, so let's start with the income statement, right? And this is going to be for the year ended. Let's see here, December 31st, 2024, right? So it's just some kind of generic item there. We're going to start with, and they want a little bit more specific here, right? With our sales revenue. All right, I'm going to put this over here. If we kind of pluck that out from over there, it's going to be $800,000, right? Take care of that. The next thing we do is, because it's in this case an income statement, they want us, and you got to back out your cost of goods sold. So they show it initially like revenues minus expenses. We will see there's kind of like a classified or more in-depth income statement, but the first step here is going to be to back out that cost of goods sold of 480. All right, so if we do the 800 minus the 480, we're looking there at 320 for our gross profit, right? Then we're going to back out our operating expenses, okay? So we're going to have, in this case, salaries, right? So let me kind of just bold some of these things. Salary expense, rent expense, depreciation expense, advertising, right? That's going to get us our total operating expenses. So if we were to pluck these guys out from that TB over there, it's going to be 120,000, 30,000, 60,000, 5,000. Hey, we sum those guys, right? We're looking at 215. We put a little item there. So what that's going to get us, right, is our operating income, right? In other words, what we do here is we take our gross profit minus the total operating expenses. Hey, we're looking at $1.05 there. Then what we got to do is back out our other expenses, right? So in this case, right, our other expense would be that interest expense from over there of $4,000. Right? When we do that, right, when we take the 105 minus the 4, hey, our net income is 101, right? There we go. We did the income statement for it. And what's going on here, right? Let's see the setup here. Okay, so we did the income statement. Now let's do the balance sheet, right? Maybe I'll kind of put a box around this just to help bifurcate. All right, next, let's do the balance sheet, okay? So we have the balance, let me move this over one. Balance sheet, and this is gonna be as of December 31st, 2024. Oops. Right, so you can see there's like slightly different language for the year ended versus as of. This is for a period of time, where this is saying a point in time. Now, because it's a classified balance sheet, we kind of have to break out these things a little bit more specifically. So we're going to start with our current assets, okay? And again, I'm just plucking these from over here. If you're wondering, like, I'm not just pulling these out of thin air. We got our cash, our accounts receivable, our inventory, our prepaid rent, right? So we're looking at 21,000, 300,000, 50,000, and then 10,000. Right, that's going to get us our total current assets. Then, right, we're going to start tackling our sort of non-current assets, right? So we'll have our property and equipment. Specifically, we'll have our office equipment, and we got to back out on that our accumulated depreciation, right? That'll get us our net book value. So let me kind of show you what's going on here, right? We put the 600,000 for that, but then we got to back out the accumulated depreciation on that fixed asset. So we're looking here, whenever you do this, right, at $350,000 carrying value for that. Then that will be able to give us our total assets. And what I mean by that is, if we take our current assets plus our non-current assets, hey, we're looking at 731,000. Right, so that would be for our assets. Next, let's do our liabilities and stockholders' equity. Right, so we'll start with our current liabilities. Right, we have our accounts payable, our salary payable, interest payable, note payable, right? Payable, 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 liability, 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 receivable, 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 asset, asset, asset. Okay, so we're just plucking those numbers from over there. 60,000, 8,000, 2,000, 60,000. We'll sum those guys. There we go. We're looking at $1.30 there for our total current liabilities. Nothing really else over there liability wise, so let's move on to our stockholders equity section. Right, we're going to have our common stock and our retained earnings. Again, I just use shorthands for this. This isn't like like you're not going to see CS exactly like in practice, but I do it to kind of save some time and be a little bit efficient for you guys. So here, when we pluck it out, it's going to be 400,000 for common stock, and our retained earnings. This is a little bit of a trick, right? Because if you go over here, right, where is the retained earnings, right? Like all of this has been, easy so far, right? I'm not seeing it. So what we have to do here is, all right, yeah, we have the 100,000. You may think that's right, but that's the problem here with it, right? Because what's going on is we have to adjust this, right? In other words, our retained earnings, because we haven't done the closing entry yet, is going to be our beginning retained earnings, which is the 100 plus any net income, the 101, minus any dividends, which there aren't any, so our ending there is going to be 201. right? So that's a little bit of a trick, right? You may think, oh, there's the 100,000, let's plug that in. Our balance sheet wouldn't balance if you did that, right? So when we have those two items, we can have our total stockholders' equity of the 400 plus the 201, and accordingly, our total liabilities plus stockholders' equity, right, is going to be the 130 plus the 601. We're at 731, right? So what this means is we balance, right? Our assets equal our liabilities plus our stockholders' equity. Right, where it's like 731, 731. Okay, let me kind of zoom out on this. Again, I'll box that off. Okay, that's great. We've done requirement 1. The next thing they're asking us is, can you please do any AJEs, right? So really what's going on here, let's kind of look at the facts. Sales revenue. Okay, give me a second here. I want to zoom in on this to kind of okay, so this is before. Okay, here we go, right? Here's requirement 2. Right, so in this case, right, what we're doing is that closing entry, right? Because we're really needing to get this to the point of, and that's exactly what 2 is saying. Can you please prepare the closing entry? So I'm trying to just think of a simple way. So here's what's going on, right? We said normally you debit expenses and you credit revenues, right? Whenever we do the closing entry, we reverse these out and then we kind of button it up into retained earnings real neat and clean, right? So what we have to do is reverse out our revenues, right? So we're going to debit our sales revenue of 800,000, and then we're going to throw that into retained earnings, right? So that would be the first closing entry for our revenues, and our second closing entry would be for our expenses, right? So you could consolidate these into one journal entry, right? But they're just kind of showing you it here piecemeal. So here we're going to debit our retained earnings and credit our cost of goods sold, credit our salary expense, credit our rent expense, credit our depreciation expense, interest expense, our advertising expense, right? We're basically flipping out, right? Normally you debit it, but here, because we're doing the closing entry, we got to get rid of all these guys, right? So it's 480, 120, 30,000, 60,000, 4,000, 5,000, and then over here, right, it's going to be for 699. Okay, so again, requirement 1 and 2, prepare an income statement and balance sheet. Income statement, balance sheet. Requirement 3, prepare the necessary closing entries. There we go, 1 and 2. Okay, so let's kind of look at this one here, exercise 218. They're giving us some information. It looks like this company prepares its books on the cash basis. Okay. However, the company recently borrowed 100 grand from a bank, and they are now required to prepare them on an accrual basis. During 2024, the following cash flows were recorded, right? So we had our inflows, we had our outflows of cash. You're now able to determine the following information for accounts receivable, prepaid expenses, and accrued liabilities. So we have our beginning balances, and we have our ending balances. And it says, in addition, you learned the bank loan was dated September 30th, 2024. There was interest at 6%. Depreciation is 10 grand. We want an accrual basis income statement. All right, so let's kind of look at this, think about this here. Okay, so if we look at these, right, let's kind of classify some of these things, what's going on here. So we went from 32 to 7 or to 27, right? We went down by $5,000. We went from 0 to 2, we went up by 2,000. We went from 1,000 to 1,500, we went up by 500. And then liabilities, accrued liabilities, 2,400 to 3,400, we went up by 1,000. Right, so we have assets for these guys, and then liabilities. Did they go up? Did they go down during the period? That's going to help us convert here from cash to accrual. Okay, and the other thing, just to kind of keep this consistent with the PowerPoint, so if you were to look at the slide in there, so if you want to reference this to help you, right? Remember, we said when you convert to cash to accrual, you can use those T accounts to help you. The other thing here is you got to be aware of is that assets, to the extent you have increases, you're going to add so let me kind of just do this in right, an increase and then a decrease. Right, for assets, you're going to add any increases and deduct any decreases. And then for your liabilities, it's going to be the reverse, right? Deduct, add. That'll make sense as we go through this. But that's kind of a nice framework. We categorized it. Did it go up or did it go down? There's the little rule set to help us, right? So let's kind of start here with the idea of, hey, we have $320,000 in cash, right? So if you think about it, right, that's cash of 320. Our receivable, right? Let me kind of move this over here. Our account receivable, it went down, right? So how much did we say it went down? Down by $5,000, right? From over there. We know, right, that our little rule here says, okay, we have a receivable that went down. We have to subtract it, right? 320 minus 5. That means in this case, right, our service revenue, to get it to balance the journal entry there, should be $315,000, right? If you think about it, right, yeah, we had a cash inflow of 320. Of that amount, $5,000 was from stuff from last period where people owed us money. So we're not going to double count that revenue. We got to back it out. 320 minus 5. That means 315 of those sales, those cash sales, must have been for stuff from this period. Okay. Next one here, if we kind of work our way down, they're telling us, let's see here. 2. Right, so they're telling us here we had $25,000 cash paid for supplies, right? So in this case, right, it was a cash outflow, right? We're going to have cash here for 25,000. Then we kind of have to back up to our journal entry, right? Here, right, with regard to the supplies, right, the increase in the account, right, because our supplies went from 1,000 to 1,500, right? It went up by $500, right, from our little thing there, right? We said supplies went up. We're looking at supplies, cash paid. If we follow our rule, right, we have an asset that went up, right? In this case, let's see, we went from 1,000 to 1,500. Then that means our supplies expense, right, to get it to balance needs to be 24.5, right? So what happens here is you kind of have to back into it. Yes, 24.5 plus the 500 gets us the 25,000. Okay. Let's look here. Right, so we can just kind of classify these 1, 2, 3. The next thing here, let's kind of see what's going on. Right, so the next thing is the insurance. We paid $6,000, right? So we have cash here of $6,000, right? You can think of that like credit cash and outflow. We know, right, that our prepaid insurance, right, in the case down there, it increased, right? We said by $2,000. So what that means is, right, our insurance expense is going to have to be $4,000, right? So we kind of have to back into it. The 4,000 plus assets increasing there, the 2,000 gives us our cash outflow of 6,000. All right, 2 more here. We have, if we look at it here, let's see what's going on. So we accounted for these guys. Next one here is the $20,000 in miscellaneous expense, right? So that was a cash outflow there of $20,000. What we have to kind of consider here are those accrued liabilities, right? So these accrued liabilities, they increased, right? And we said they went up by 1,000 there. So what that means is, right, when we do our sort of miscellaneous expense for accrual purposes, right, to get that to balance, it's going to be $21,000. Okay, we have an increase in a liability there. 5, last one here. This is just really kind of given this additional fact that we borrowed that money at 6%, right? So we're going to have our interest expense and our interest payable, right? What are the amounts for this? Well, we borrowed $100,000 at a 6% rate, and 3 out of the 12 months have passed, right? So we're looking at $1,500 there for that guy. If we were then to prepare, right, so we've kind of made the adjusting journal entries here to figure out our accrual basis expenses. If we were then to do the income statement for this, right, we would have our service revenue of the 315. We then would back out our operating expenses right? So these would be things like salary expense, supplies expense, rent expense, insurance expense, miscellaneous expense, depreciation expense. Right, so these guys we would nab. So right, it would be 180,000, 24,500, 12,000, 4,000, 21,000, 10,000. Right, so we're looking here at total operating expenses of 251. That's going to get us, in this case, our operating income of $63,500. We got to back out our other expenses in this case, right? Our interest expense of $1,500 that we calculated. That will get us our net income specifically. Right, we'll take our operating income minus that other expense, 62,000. Okay, there we go. So we have our journal entries, and then we have our accrual basis income statement. Now the last one here, the problem, right? The P21, right? We're not going to do this because we're kind of running out of time. What's going on with this, right? They're really kind of making you do the whole shooting match, right? So I'm going to bring down the answer key here just to show you if you wanted to pause it, what's going on. So let me kind of bring this down. Right, so they're giving us these journal entries here, right? They want you to do the general journal entries, right? So if you look at it, right, here's the like January 1st. You can pause it and kind of tie that out, right? How you would do those journal entries. And then every time you do the journal entry, right, you got to post it over to the T account, right? So our cash here, $1,000 debit on January 1st, right? You can see it right there, $100,000, $100,000. Inventory, 35, right? 35. So you can see every one, the 100, the 100, the 35, the 35, you carry it over to those T accounts, right? It's like general journal, like kind of general ledger, right? Then they want you to do an unadjusted trial balance, right? So what you then do is you take all of these ending balances from all those T accounts and you put them down there, okay? So you can pause it, right? Like look at that if you kind of really want to do it, but I don't want to make this video like unbelievably long. So with that, we'll stop here. We'll see you guys in the next chapter of class.